Happy New Year, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the first pre-market show of the new year with Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. Happy New Year, buddy.
Happy New Year, and Happy New Year to everybody there. How's your New Year, Will?
It's good.
Good.
Kids were out at parties, so my wife and I did stay up. Saw actually there was a really good football game at the same time. I don't know if you watched either of the playoff games, but it was down to a field goal, and literally it was right at midnight that you either could watch the ball drop or the field goal be kicked. And I was with my youngest daughter and my wife, and the vote was to watch the ball drop. So I missed it was actually the field goal was missed at the end of the game, but it was a good game too. So it was a nice New Year's.
Yeah, I watched football weekend, but my wife didn't let me on New Year's. She said no football, so there's I wasn't allowed to watch any football that day.
Yeah, we missed the two best games. It was incredible.
Yep.
So you want to start with the disclaimer?
Yep. Good morning, everyone, and Happy New Year. Before we get started, just keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your RIA or your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Awesome.
I'm going to share my screen. If you guys are joining us for the first time, we really do this show to answer any questions you may have. Could be Market Chameleon tools, data, analytics, strategies. You want to discuss something you've seen out there and share it with the community. You're welcome to either ask the question by putting your question on the live chat on YouTube. Will's watching it and he'll read it back to me. If you want to come on the show and ask your question live, we also provide a link to Zoom. If you click on that link, it takes you over to Zoom. Once you get into Zoom, there's a button, raise your hand, at the bottom of the screen. Click on that. They'll prompt you to turn on your video camera. You don't have to turn on your video camera, but once we let you in, everybody could hear you. You can ask your question then live and direct. While we're waiting for questions to come in, I did get some questions over the email. One of them, the one on the top of the list right now, is the implied volatility skew. There is a question, and I think I'll start with that one because I do get questions on implied volatility skew often, and it had to do with comparing 25 delta calls versus 25 delta put skew. So let's start discussing that. And if more questions come in after that, I'll try to take those today as well.
Perfect.
Okay. Before we get to that, let's just take a quick look at the pre-market report. After this, actually, I'll take a look at SPY and just see how the market tended to perform in January, since we're start of the month. We finished off the year with not good this year. I think over 20, like almost 20% down in the S&P 500. But let's see.
I think it was the worst down year since 2008, actually.
Yeah, it's a really bad year. Let's see how January tended to how the market tended to perform in the month of January, how volatility performed in the month of January. I'm going to take a quick look at that as well, and then I'm going to jump to implied volatility skew. All right. But of course, we'll do the pre-market report first. And that is here, pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. I see 129 stocks made our percentage gainers list, 50 on the decliners. From this perspective, right now we're looking like we're setting up for more bullish bias at the open. Let's filter down this list to only S&P 500 companies. So we want to take out ETFs, leverage products, closed-end funds, small cap stocks. Let's take all of those out just to see what's going on in those S&P 500 stocks. And to do that, I'm going to use filters above. This one in ETF. I'm going to drop it down. It gives me a list of ETFs. When you select one of these ETFs, the list below will get filtered by stocks that are holdings in that ETF. and SPY, that's the S&P 500 ETF. Select that. And now the list below will get filtered by stocks that are holdings or constituents of SPY ETF, which are the S&P 500 constituents. And here we see 23 stocks made the percentage gainers list, 4 in the decliners. Again, so far, we're lining up like a bullish bias at the open. Only one kind of sticks out right now, Tesla down 4%. And I think that they reported what their deliveries, the car deliveries, a big number people look at, and that came in a little bit lighter than usual or than expected.
Well, yeah, what they were expecting. They were expecting a 50% increase, and I guess it was 40 some odd percent.
Right, and I think right now, yeah, the stock was pretty much priced for 50% growth year over year when we looked at it. So we did take a look at what a fair value would be, and what the market's expectations are potentially for the growth. And it looks like 50% or more really growing year over year for the next for a long time, basically. They came in lighter, but of course, Tesla has been down a lot as well. So we'll see how that does, but down 4% in the pre-markets this morning. And that
you and your son did a little math, didn't you? And Tesla's down as much as Bitcoin, right? Or Ethereum.
I think, yeah, we were looking at Tesla, and if you invested in, let me see really quickly, you could have, this is the 1 year performance. Thinks it's down 65%, but if you take it from the high, it's down as much as like Bitcoin or Ethereum, which lost, I don't know, it's 70% of its value, something like that, 75%. So very similar. You could have either owned Tesla or even the crypto, and if you bought them at the high, held them to here, similar performance. But you see the 5-year performance still pretty good, up almost 500% in the last 5 years. Let's go to SPY since I came off. What I wanted to take a look, since we are starting out the year, let's see how SPY, S&P 500 ETF, how it tended to perform in the month of January. So this is a seasonality table based on calendar month. You can see here right now we're in January. And January, if we looked at, this is the full month's performance year over year, well, each year. And 60% of the time, you could see here that it ended up on a downside. So 40% of the time it was higher, 60% lower since 2013. But on average, it still managed to gain 0.3%. And that's because you can see that the averages, are pulled up by some of these big years where the stock market was up 8%, 2019 up 8%, 2018 up 5.6. So on the up months had some pretty big up months here. I'm just kind of making an observation where, on years that, let me see, it was down. So this year it was down if it was a follow through. So here it was down. So down 9.3%. Just seeing if I could see a pattern here of, if the month of December was down, what happened to the month of January? But I kind of have to eyeball it there. Another thing we could look at is the magnitude of the move on the calendar month, kind of like volatility, but instead of volatility, we're just going to look at basically absolute average move in the calendar month. And what that does is convert these values all to positive, and then takes the average to get the average absolute move. And you can see month of January, 3.8%. compared to the month of December, 3.3. So a little bit more volatility in the month of January usually than December. And I think December does tend to come in a little bit because we have a lot of holidays. Looks like pops a little bit in January, stays there. January, February, March, similar, starts dropping off in the summer months. Okay, so that's kind of like where the volatility is on a historical basis. If there are no, the other thing here, the median move in month of January is down 0.5%. So that would be the second worst month, calendar month, in terms of the median move. And the median move, instead of the average, it looks at all these observations and takes the middle. So the middle part this way, a big move either up or down, doesn't skew the entire average. It looks at the middle numbers. Okay, so you can see here, September, the median down 1.2%. The next worst one, January, down 0.5%.
Hey, D, is there any way to tell? We have a new user area, and they asked, and I don't think we have the data for this. It's the first day of trading always up. Is that true? They had heard. Can we filter for that?
The first day of trading?
Yeah, and I'm assuming, I mean, you're on the SP. I'm assuming the SPY is a good indicator. I don't know if she's asking that.
Let me see if I can do it here. So let me just see SPY. If I turn it to seasonal, let me see if I could do it. So I could put in dates here, but I'm not sure if the first day of trading is always the third. Let's do the second to the third or to the fourth. Let's find out here. I'm going to do it on a 2-day because I think the first day of trading is usually the second or the third. So we'll do the second to the fourth. And here we could see it's kind of a mixed bag, but yeah, 58% of the historical observation in the last 12 years, 58% were higher, 33% lower. Here's your average gain, about 0.25%. Average up move, about close to 1%, almost. Average down move, same, similar, 0.88%. And that's the largest move, 1.8% to the upside. So from here, entering these 2 dates, it looks like it tended to be more positive days than negative historically, the beginning of the year. Hopefully that helps answer that question. You could kind of come down here and take a look at the, year by year stats and so forth.
Yeah, that's helpful. Thanks, Steve.
Yep. Let me get to the question of skew. And it was a good question. Let's start out with this on activity. And it was, a user, one of our customers, looking at the skew, and basically had a question where, what is this skew telling us, and is it bearish or bullish, and how do we kind of read it? And there are different ways to look at skew. This one's looking at it from the perspective of implied volatility. Sometimes I like to look at it from the perspective of premium, but what skew is, it's comparing options in the same month on a relative basis. And what it looks at is tries to look at a bearish put, a downside bearish put, which we'll say 25 delta put, and a bullish call, 25 delta call. So it wants to looking at 2 out of the money options, and the skew is how are they priced relative to each other? Okay, in the market, how are they? Is one more expensive than the other, and by how much? And it's on a relative basis. In finance, a lot of valuation is on a relative basis. Okay, you even stocks, you could say, are also priced on a relative basis because you have these multiples of.
Hey D, can you just go through again the clicks that you use to get to this page?
Yeah. So when here I typed in SPY, and under options, there's this activity here, and this kind of breaks down options volume in different ways. Okay, so this one, the first one, it's under activity volatility skew here. And when we look at the volatility skew, we have to, if we say, well, if we're going to compare it on a relative basis, what is the benchmark that we're comparing it to? Okay. And in this situation here, okay, the volatility skew, we're looking at every different calendar month. And you can see there are options in SPY that go all the way to the year 2025, right? And a bunch of expiration months in between, a lot of them. And each expiration will have a different implied volatility, right? You can see here there's implied volatility for each expiration. And then they'll have a different implied volatility for 25 delta put and 25 delta call. And you could see here, we're measuring the skew on each particular expiration. That's what this is, and we have a screener for it. But let's stay on here just to concentrate on SPY. But I believe the screenshot was from the screener, which was showing this same data in a screener with all the other stocks.
Hey D, while you're talking about screeners, Raj was asking, is there a way to rank sectors based on seasonality?
That's a good, that probably is a good analytic, but I don't think I have like a ranking. Maybe a way to compare them, but not to rank them. Here, I'll come back to it. But
we can think about that and maybe look at that tomorrow. And while I have questions, David, who's been actively, I think David may have been the one who came over and was live the other day. He asked, it would be great to look at the options for SPY for the large Jan 20th expiration, put in call ratios, etc., to see if there's something in the options that can tell us if there's any sort of bias on where SPY may end up towards the end of January, I guess. That was his question. Also something maybe we can think about looking at tomorrow or something.
Okay.
Get that.
All right. Yeah, those are two good questions. Let me try to finish the skew one today, and then we'll come back to those questions. Just jot them down for me.
I will.
And try to. All right. So come back to the skew. What we want to do here, the objective is to get a sense of, in each expiration, how much skews in the put, how much skews in the call. Okay. And we want to do it in a quick way, because otherwise we have to go to the options chain and try to figure all this out. And this is a way to do it faster. And on a relative basis, what we could do is say, okay, here is the at the money implied volatility, right? So we have an at the money implied volatility, 21.7, let's say, or, let's go out. This is the month, actually, somebody was asking about, but here's one, 22.1. And if we want to know, well, if I'm looking at puts and calls, how expensive or cheap are they relative to the at the monies? Okay. So this skew is saying that if you ran 22.1 implied volatility through all the strikes, so you ran one volatility through all the strikes, all the way down, and then you found the 25 delta put on a straight vol. If you found that 25 delta put, what is that implied volatility, and how much higher or lower is than the at the money? So this situation, you could see that the implied volatility of the put, 25 delta put, is 5.7% higher than the at the money. Okay, so you would be paying more for that in implied volatility terms, more for the 25 delta put than for that at the money. And then if we did the same thing for the 25 delta call and said, well, where's the implied volatility for the 25 delta call versus at the money? This is saying that this is 10.5% below. So when I just clicked on it, it showed me the graph here. So you could see how the implied volatilities change as you change strikes, right? So these are based on strikes here, and this is comparing finding the delta 25 delta puts and calls and showing how much on a relative basis their price versus at the money, right? So that's really quickly allowing us to know, well, okay, the put here is higher than that the money, the call here is below that the money IV, and this is by how much? By 5.7, 10.5. So I was just looking at this expiration, then it's quickly I could assess that. I could see here, that March, the put is skewed much higher, than in January, up 10%, and the call is skewed much lower than down here. It's down 14.5%. So just scanning with my eyes, I could probably find the call with the biggest skew, going all the way out here, and the put with the biggest skew. And then the question is, the question was, well, if the puts, right, are skewed higher than the calls, right, then is that bullish or bearish? And usually in SPY, we'll see that, right? The puts are usually skewed higher than the calls. The reason is that, people buy puts for protection. So there was a demand to own puts to protect large positions, and people write calls. Probably the 25 delta call would be the most popular call to buy right. And there's pressure on selling calls because people will sell calls to try to yield harvest or, buy right.
Hey, D, while you're talking about the 25 delta calls, Laurent was asking, are the 25 deltas from the actual option chains, or are they derived from the roll-in IV30? He says, I'm asking because not every chain has an exact 25 delta.
Right. So it's a derived value, and the 25 delta call and put from this example. Let me come back to the options chain. It doesn't look at, let's say, so here you see a 25, here are the deltas. This is the options chain for the calls, side for the puts. So this 25 delta, somewhere right in between here, would be based on this implied volatility, right? This 25 delta, here's a 25 delta, would be based on this implied volatility, 23.5. And this one, would be based on 20. So you could see there's a skew. This implied volatility is lower than this one. Now to get the skew, what we will do is say, show me what the value of all these options would be if there was no skew. So I'm just going to run a straight skew. What is that, the money? Let's say 22, 22.1, something like that. So you can see 22.1. See, these are the theoretical values. They change. Right. So you can see that these theoretical values are higher because if I run 22.1 implied volatility, right, it's higher than 19.4. So the theoretical value of this option is higher than the market. And if I run 22.1 volatility, let's say in this option, then the theoretical value is lower than the market price, because the market price is 20, the implied volatility is 24.1. So what it does is find the 25 delta call and put based on the straight skew, 22.1. I'm running 22.1 through all the options, and then finding. So this one is not, this one's still using implieds. So the 25 delta option, I don't know, might be somewhere like actually even higher, somewhere down here. Up here, 25 delta will be a little bit closer. And then it's comparing these implied vols versus that the money. Okay, versus that the money. Okay, so that's what the delta is. But you could see that it's gonna be, the puts will usually always be skewed higher than the calls, right? So in essence, yeah, more buyers of puts, usually for protection. A lot of buy writing as the market goes up, so those will be skewed lower. And on a relative basis, even though there's always a skew, right? What we want to compare it to is a historical skew to see if it's more, are people leaning more bullish or bearish on a relative basis. And that's what this one is here. So here, when we look at skew, we can see, well, why is it in the more bullish sector? Well, the skew, see this yellow line here, right? This yellow line is telling us the average skew versus today's skew. So even though people are paying more for puts than for calls today, they're on average, they even pay a higher premium than we see now. Okay, so on average, people pay up a higher premium relative to the calls than they are today, even though that premium still exists, right? And that's why it's in this part, the more bullish. Basically, what it's saying is that, yes, there's a skew right now, but on average, if we look back in history, that the price paid for the puts relative to the calls were even higher. Okay, so that's what it's doing. It's looking at the relative basis versus the average, not just today's, but versus the average. And that's based on a 30-day constant maturity. Okay, so that's on a 30-day constant maturity. Hopefully, that helps out with that question. If not, you could do a follow-up question or email me, but I did say I was going to cover that implied volatility skew today.
Well, that was super helpful, Dee. Thanks so much. Great start to the new year. Thanks everyone for joining. Again, awesome job, Dee.
All right. Thanks everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.